I'm very pleased to be on a panel for the EU Financial Regulation Conference. I work at M&G, as Charles says, as Head of Alternative Credit. M&G is the wholly owned subsidiary of Prudential plc, and we manage monies on behalf of Prudential's insurance companies, pension funds, and as well as retail. And I joined in 1997, and I've been expanding the unlisted debt securities activities. And in that year, we had under £1 billion under management in those categories, and now it's over 20 billion. And that includes activities such as private placements, leveraged finance, infrastructure funding, real estate funding, and structured products. These activities have obviously involved me in lots of hours, if not days or weeks, involved on regulation, especially when we were the first investor in Europe to undertake some of these activities. So I view myself here as the end user of regulations for this conference. And it's been very interesting to hear the first panel, and I know it'd be a theme of today is how do we move in Europe from a model which is totally bank funded to one which is more capital markets. And I want to make 5 points on that and then make a final plea. The first point is, what do you want the financial sector to do? And I think there's lots of conflicting messages. The usual one which is used is banks are told to go out and lend more. Oh, but by the way, improve your capital ratios. The one I want to use is on infrastructure financing. Everyone knew under Basel III, banks couldn't do long-term lending anymore. And at the same time, since the crisis, obviously governments have had to cut their public expenditure because of their debt problems. So therefore, private capital should have come in to help. But that hasn't happened. Why? Because there's been a lack of certainty on regulations. For example, Solvency II, which has also infected pension funds. So when we talk to pension funds to go into that asset class, they'll go and say, oh, we're a bit worried that Solvency II may be introduced in the next decade. So why would we make a long-term investment when that might happen? So it's a lack of certainty. So that is an example of what do you want the financial sector to do. Second point I'd like to raise is, could the politicians and regulators please think about the real-world consequences of regulations that are being introduced? And by that, I want to use one example. Basel III has meant the liquidity in the public debt securities markets has completely dropped. From data in the US, BlackRock have said that banks used to hold stock of about $233 billion of stock for trading in the US in 2007. That number is now around 50 billion. So basically, there is much less liquidity in the market. So therefore, any regulator or politician who's thinking about introducing regulation, it's no use trying to pretend that liquidity is the same level as it was pre-crisis. We are living in a world of much less liquidity. Obviously, leading on to that point, and someone in charge of unlisted debt, I'm going to say that people should be considering private assets. And the good news is, as has been explained by the first speaker on this panel, that there is some good news that people are thinking along that. Because I actually think investors would be, and I know this from talking to pension funds and other investors over the last 16 years, are interested in what cash flows and returns they earn from investments, rather than just how the benchmark performs. And private assets can be much more flexible. You can have your return in fixed format, floating rate, inflation linked. You might have security on some investments. Covenants can be included in those investments which take out the volatility. And also you can have more diversification, and that's a big point. There are a greater number of businesses who will have where you can do private loans rather than just public securities and sectors. And I'd include obviously infrastructure in that. The fourth point is, do you want financial innovation? If you move to a regulatory system which is totally built around calibrations, you're not going to get financial innovation because there is no track record. And I suppose you might say we've had enough fun with financial innovation. pre-crisis with all the various structures, whether it's CDOs and various other aspects. But remember, many of those structures collapsed because of the poor lending underpinning those. So creating a structure around loans, which are to people who have no jobs and no income, as in the US, was the problem. It wasn't so much the structure. So I think most regulators have to think about, do you want financial innovation going forward? Fifth point I want to make is, can we please have joined up regulations and intentions? And I want to talk a bit about a recent example which has happened in the last few weeks. As you know, politicians and Mario Draghi have been trying to encourage SME ABS, which is the asset-backed securities, where we as an investor, because we obviously haven't got the network, we can't do small loans, but we can buy a package of those loans from banks who we know are doing the right credit research, and we've been doing that for a long time for our insurance company. So because of the positive noises being made, we created a fund, and we went to talk to pension funds, and we got interest. We worked on an investment with a obviously unnamed bank. We agreed pricing. We were just about to close, and we found out we couldn't do the investment for this fund. Why? Because out right field, the AIFMD regulations meant that we are a European fund manager under that, and the bank concerned had marketed not only to us and other European fund managers, but they'd marketed to global investors and self-invested pension funds, and those two last parties are not part of AIFMD. And you might say, well, what difference does that make? Well, for a bank, they have to, under AIFMD, if someone buys a security, they would have to give a warranty that they keep 5% skin in the game. This is the famous skin in the game. But if they sell that same piece of paper to a non-AIFMD, please hang on in there and follow me, they don't have to give that rep and warranty. And human behaviour being what it is, guess what the bank said is, well, if I don't have to give that rep and warranty, I won't. Now, so we did all this work, we raised the fund, we thought we were doing what people wanted. We find out that going forward, the banks can market it to non-AIFMD fund managers and investors and not involve us as a European fund manager. I don't think that is what was intended by the politicians. But I'm not really blaming the regulator who came up with AIFMD and put this section 122, sorry to name a clause, but obviously I've lived with this over the last few weeks, because in isolation it probably made sense. But the thing is here, we had no one to go to sort this problem out. There is no one. So I think that's enough points. So the 5 points which I've sort of covered is, 1, what do you want the financial sector to do? 2, what are the real-world consequences of any regulations? Also, third point, are the measures contributing to this move from the bank finance model to a more balanced forms of finance for issuers and borrowers? And obviously, the 4th point was my personal plea. Can we have more welcoming of private assets rather than public, especially as public assets are becoming less liquid and actually there are less diverse companies issuing in the public markets? And the 5th point was obviously, can we build in some flexibility for regulations to cover the unintended consequences? Because no regulation is perfect on day one, but we don't seem to have this mechanism to try and amend regulation if 1 or 2 things go wrong. So that leaves, just to finish off, what is my plea? I think every time someone introduces a new regulation, the first thing they should say is, what is this doing for the growth agenda in Europe? Everyone in this room should be working to make a contribution to Europe growing again. And we do need to move away from this bank finance model to one which is more balanced, as I say. And investors are vital to that. So please, please, can we make the regulatory system more welcoming for investors, and whether that's insurance companies, pension funds, or retail? And that plea really is to politicians who are creating the new rules as well as regulators. And then we can all be contributing to Europe growing again.